At the Santelli Exchange. Morning again, Rick.
Good morning, Carl. I'd like to welcome my first Friday of the month guest, Ed Lazear, of course, former chair of the Economic Council of Advisors under George W. Bush. Ed, thank you for joining me today. Wow, 266,000 upgrades to wages. Looked like a pretty good report to me. What did you think?
Yeah, I mean, there's no question. This is one of the strongest reports we've seen in a very long time. The truth is it's surprising because we're pretty much at full employment. To be getting numbers like 266, I always like to smooth these things and look at the 3-month moving average rather than the individual month. But, look, the 3-month average was 205,000. So even there, we're way up. So the question is, what's going on? Why is that? How can we be this late in the recovery and still be getting jobs like that? And I would say it's primarily a couple of things. The first is that it turned out population growth this month was actually very high. So part of the job growth reflects the fact that we actually have more people in the population and in the labor force. So that's number one. The second thing is that, the baby boomers are a driven generation. If you look at the numbers right now and you look at labor force participation, the employment rate among 65 plus is 25%. That's unprecedented. It's an all-time high. But it's also true in the rest of the labor force as well. People 25 to 54-year-olds are at their pre-recession peak now in terms of employment rates. So everything is just going on all cylinders. We've got a very hot and very strong labor market.
Now, when it comes to Q4, it looked like at one point it was going to be a light GDP quarter.
Yeah.
Does this late stage number well into the 2019 last labor report of the year, is this going to change Q4 metrics either materially or psychologically, in your opinion?
Well, it certainly helps. The obvious thing for Q4 is that business investment, capital expenditures, we know was weak in the last quarter, and the question is whether that will continue or whether that will pick up. Consumption's been pretty strong, as you know, 4% growth in consumption. And housing's been pretty strong. So we've got a few things going in our favor. If you look at the market, not just so much for Q4, but if you look at what the market is saying about the next 4 quarters, the market's predicting it was at 1.5% growth. Now it's predicting 2 to 2.5% growth. So things have definitely turned around from where they were even 6 months ago.
There seems to have been an asymmetric assumption in this number, and I do think it was well-founded, that a strong number will probably do less to bring back a Fed tightening mentality than a weak number, a Fed easing mentality. Now, having said that, it certainly seems as though the Phillips curve is having another funeral procession. Your thought?
Yeah, absolutely. The advocates of the Phillips curve will say that, well, the reason we don't tend to see the Phillips curve right now is because the Fed is doing such a good job that it offsets all of the movements that one would normally see if the Phillips curve were actually working. That's a positive spin on it. I've never been a big believer in the strength of the Phillips curve as a big predictor of what's going on in the economy. I like to think in terms of the fundamentals. The fundamentals that I look at are things like productivity growth, like demand, and so forth. And right now, if we think about productivity growth, actually, you mentioned this earlier this morning. You talked about a rainout. I thought that was kind of a funny way to put it. But if you looked at 2015 and 2016, that was a relatively weak period. In the past year, we've had productivity growth of about 2%. So that's a good deal, and it also means that we can tolerate 4% nominal wage growth without having any inflationary pressure. So all of those things are good and are strong signals for the future.
And you know what? This is going to blend in with what you just answered, but in the last 40 seconds, I'd still like to dig down deeper.
Sure.
This notion that wages are somehow insufficient, not good, they were better in the past, because it isn't pushing up inflation. And in your final answer, I don't think you would agree with that.
I don't agree with it. And the best news on wages, actually, again, it comes back to the earlier segment I was watching you this morning. The best thing about wages is not only are wages growing finally at a reasonably high pace, but the wages at the bottom are actually growing faster than the wages at the median. So if you look at the bottom 10th percentile the people who were earning in the lowest 10% of the country, their growth has been about 2 to 3 times as high as the median. And that's really good news because that hasn't happened in a very long time. So, again, that's a sign of strength. It's a sign of general strength throughout the economy and something that we like to see right now.